Welcome to Richie Shot.
Welcome back to the Richie Shot, your fast and fresh take on the stories moving markets. Gold is glittering at record highs, the Fed may be rewriting its playbook, inflation is steady with rate cuts on the horizon, Starbucks is brewing a $1 billion reset, and BMO Capital just called 7,000 for the S&P 500. Let's dive in. Markets on the move, gold shines bright. Markets may be full of ups and downs, but right now one thing is glowing with unstoppable energy: gold. The world's favorite safe haven has been on a remarkable rally, pushing close to record highs as global uncertainty fuels demand. On Tuesday, prices briefly soared above $3,791 per ounce, setting a fresh all-time record, before easing slightly to $3,745. Still up nearly 2% for the week. What's driving this golden glow? A perfect mix of strong central bank buying, the Fed's return to rate cuts, and investors pouring into gold-backed ETFs, which have reached their highest levels since 2022. With momentum this strong, gold is on track for its sixth consecutive weekly gain and preparing to wrap up the third quarter in dazzling style. Major banks, including Goldman Sachs, are confident this rally has more room to run, and the next big spotlight is Friday's release of the U.S. core PCE inflation data, the Fed's favorite inflation gauge. Forecasts suggest prices rose 0.2% in August, keeping the annual rate steady at 2.9%. The bigger picture? Since the start of the year, gold has already surged 43%, turning 2025 into a truly golden chapter for investors. Markets move fast, but right now, gold is simply shining brighter than ever. Inflation steady, cuts on the horizon. Inflation is holding steady, and that's music to Wall Street's ears. According to Friday's Commerce Department release, the Personal Consumption Expenditures (PCE) index, the Federal Reserve's favorite inflation measure, rose 0.3% in August, nudging the annual headline rate to 2.7%, just slightly above July's 2.6%. The more closely watched core PCE, which excludes food and energy, remained unchanged at 2.9% year-over-year, climbing a modest 0.2% for the month. That means inflation is moving in exactly the direction policymakers want: slower, steadier, and without surprises. In fact, the report landed perfectly in line with the Dow Jones consensus forecast. Meanwhile, the American consumer is proving resilient. Personal incomes rose 0.4% in August, while spending climbed 0.6%, both edging past expectations. The data points to a healthy balance. Households still have momentum, and price pressures aren't overheating. For the Fed, this is the ideal scenario. With inflation anchored and growth intact, officials are likely to keep moving toward rate cuts later this year, a shift that markets have already been pricing in. Steady inflation, solid spending. Sounds like the Fed just got its golden ticket to cut. A new era for Fed policy? The Fed's playbook hasn't changed since the 80s, until now maybe. And yes, the spark comes from Texas. In a surprising move, Dallas Fed President Lori Logan suggested it's time for the U.S. Central Bank to consider a brand new focus. For decades, the Federal Reserve has steered the economy with a federal funds rate. But Logan says the spotlight should shift to the repo rate, a market gauge that actually drives much of today's short-term funding. Speaking at a Richmond Fed event, she highlighted how the old federal funds market has faded over the past 15 years, replaced by booming repo transactions. That makes targeting the repo rate a more realistic and effective way to guide monetary policy. Her comments lit a fire under a debate investors have been waiting for. Bank of America's Mark Cabana cheered the idea, calling it a step in the right direction and crediting Logan for jump-starting the long-overdue conversation. If this gains traction, it could be the first big policy shift in U.S. monetary history since the 1980s. BMO sees S&P 500 at 7,000. Wall Street's optimism just got a big boost. BMO Capital has lifted its year-end target for the S&P 500 to 7,000, moving what was once its bull case scenario into its official forecast. Analysts say the revision reflects the sheer strength of the 2025 rally and the resilience of the U.S. market. In a client note, BMO admitted it expects cynicism over such a bold move, but emphasized it has long argued the U.S. stock market is in the middle of a 25-year secular bull run, a call it has repeated for more than 15 years. That conviction, the bank said, kept its portfolios fully invested through 2025, leading to the best quarterly performance in over 2 decades during the second quarter. The firm acknowledged that markets rarely move in straight lines, warning of a potential blow-off top and a natural settling phase at 7,000. Still, the conditions remain highly supportive. Fed rate cuts are in play, earnings are firming, market breadth is improving, and there's no sign of an AI-driven bubble. In fact, BMO says 2025 could be shaping up like a 1995 to 1996 Goldilocks redux, a sweet spot for growth, stability, and gains. Markets move fast, and BMO just doubled down on the bull.
Starbucks brews a bold reset. Starbucks is stirring things up with a $1 billion restructuring plan, marking the boldest step yet in its Back to Starbucks transformation under new CEO Brian Niccol. The company announced Thursday that it will close about 500 net stores in North America during fiscal 2025, roughly a 1% decline in company-operated units. The changes come with tough decisions. About 900 non-retail employees are set to be laid off, and Starbucks estimates it will face $150 million in employee separation costs, alongside $850 million in store-related restructuring charges. Most of these expenses will hit in fiscal 2025. By year's end, Starbucks still expects to have nearly 18,300 North American locations, a sign that the brand's footprint remains vast. Importantly, growth is set to return in fiscal 2026, with Niccol emphasizing a renewed focus on investments closer to the coffeehouse and the customer. The backdrop: Starbucks has seen 6 straight quarters of declining same-store sales in its biggest market, pressured by stiff competition and more cautious consumer spending. The reset is designed to streamline operations, refresh the brand, and rebuild momentum. Investors and coffee lovers alike will be watching whether this bold brew delivers the caffeine kick Starbucks needs. Markets move fast, and Starbucks is betting a reset today will mean stronger growth tomorrow.